Let's check in now with Winnie Cisar. She is Wells Fargo Securities Head of Credit Strategy. And Winnie, great to have you here. Thanks for making time for us this morning.
Thanks for having me.
So just your take on the Federal Reserve. What would you like to hear Jay Powell and company say at the conclusion of their meeting tomorrow?
So what we're looking for in terms of the corporate credit markets is really the Fed's intentions. Right now, it's our understanding that the Fed is trying to mitigate jump to default risk. The Fed wants to support companies that were solvent heading into this crisis so that we don't have this rash of defaults for higher quality companies that drives a massive uptick in volatility in the higher rated parts of the corporate credit market. Now, what we don't want is the Fed just coming in and saying, we are now a risk asset buyer. We're going to buy triple C's, because to be clear, there needs to be at least some sort of default cycle for the companies that went into this crisis already over leveraged, already stressed. So we're hoping that the Fed is going to have a very concise message about being the lender of last resort for the credit markets and providing a backstop of liquidity, but not necessarily artificially inflating asset prices all the way down the credit spectrum.
Winnie, how do you think the next, let's say 2 to 3 months will look like for investment grade issuers? Do you expect defaults there to pick up as well? I get it in some of the lower tier companies. I mean, look at a JCPenney, they're under a lot of pressure here too as well, a lot of retailers, but the investment grade companies, will we see defaults there too?
We are not expecting to see that jump to default risk from IG all the way down to default. In order for that to happen, we would really need to see liquidity absolutely dry up in the investment grade market. And instead, we're seeing the opposite. The mere fact that the Fed has come in and said, we're willing to provide liquidity to the highest rated borrowers has basically given investors enough comfort that they're willing to put capital to work in the new issue market. We're seeing robust high grade issuance for a wide variety of issuers, not only the AA and single A rated companies, but some triple Bs, some double Bs that were recently downgraded, and seeing at least investor receptivity to those deals. And so as long as IG issuers have that short-term liquidity source, I would be really hard pressed to figure out how we're going to have high-grade defaults actually materialize.
You know, Winnie, I've noticed that credit spreads have been much more range-bound over the past few weeks. Why do you think that is?
So we've noticed that as well. And what we think is it's a combination of factors. First, you have investors staring down a very uncertain timeline regarding reopening economies. And even when economies are reopened, what does that really mean in terms of the consumer going out and spending their dollars like they were before? We're staring down a very challenging earnings season, very challenging economic data, and also the heavy new issue supply that I mentioned in the investment grade market has also started to trickle into the high yield market. So investors are basically forced to put their capital to work in the primary market, which lets the kind of secondary market spreads just kind of linger in this more range-bound area. And really, ultimately, what's keeping a lid on spread widening right now, we think, is the fact that the Fed's credit programs merely exist. That basically provides a backstop against any credit investors really trying to get short the market or underweight the market, because we know that there's going to be some sort of intervention in that market to keep things stable.
What about for investors who maybe are in a nice position where they have a little cash on hand that they want to put to work? They have a bit of an iron stomach. Where would you see opportunity for them right now in the credit markets?
So we have been increasingly ratcheting up our risk appetite. So I would say that the first place that you want to be is where the Fed is most directly supporting the markets. That's in the front end of the curve in investment grade. That's where we would be willing to take a little bit more of our beta risk. And then also in the high yield market, in the double B segment of the market, which relative to the year-to-date tights and relative to as wide as we got, has not retraced as much of its gains as kind of the optical all-in yield would indicate. So we're moving down into high yield, into double B issuers, into some higher quality single B issuers that have recently demonstrated their ability to get liquidity done in the primary market.
Winnie, what does the road to recovery look like for corporate America? At the end of the day, do you expect there will be some form of day of reckoning when all this debt comes due? And then by extension, what does that mean for equity investors?
So, the reopening is very uncertain, right? I think there's going to be a lot of kind of stop and go moments. And I think that investors are mentally preparing themselves for that. Now, what I think is really important in the debt versus equity story is for the past few years, what we've seen is corporate credit issuers issuing debt to boost equity to returns, do share buybacks, pay big hefty dividends. And that type of trend has already begun to change with a number of companies suspending buybacks, suspending dividends. So I think that what we could see is a little bit more of credit market performance, in that investors in the credit market are going to be much more focused on, all right, if we have provided you this short-term liquidity facility, we want to see some sort of repayment of that at the expense of stockholders. So some sort of divergence in terms of equity performance and credit performance, I think, is a very reasonable base case scenario in the near term.
All right, Winnie Cisar of Wells Fargo, thank you so much for being with us today and for sharing your thoughts on the credit markets. Be well.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.